The money market is a part of financial market where short-term financial instruments are traded. These instruments usually have maturity of less than 1 year. The primary purpose of the money market is to provide liquidity to participants such as government, banks, and corporations by facilitating short-term borrowing and lending. How the financial market work? Financial market work to raise fund. Borrowers such as government or companies sell this instrument. They are bought by lenders such as bank or investor in order to earn the interest. To keep the market balanced, central bank keep an eye on it and make it necessary adjustment.
Next, market players for the instrument. Central Bank Asal Bank Negara Malaysia use Repurchase Agreement as a tool for monetary policy. Through repos, BNM manage real liquidity in the financial system, ensuring stable interest rates and maintaining economic stability. Next, money market funds. Money market funds are major investor in repos. They are prioritize low-risk short-term instruments like repos to ensure liquidity and provide consistent returns for their investor. Corporate treasurer, they Malaysian corporation also use repos to manage surplus cash. For them, repos offer secure and efficient way to invest excess funds while maintaining liquidity for operational needs. And that pension fund, asset managers, institutions such as Malaysia Employees Provident Funds and other asset managers participate in repos to generate return on their cash holdings. This ensures that they balance short-term liquidity needs while focusing on long-term investment for their stakeholders. And insurance companies, they are engaged in repos to manage their cash reserve and earn secure returns on surplus fund. This align with their need to manage risk carefully. Banks, local banks in Malaysia actively participate in the repo market. They rely on repos to manage liquidity, meet BNM reserve requirement, and ensure smooth operation in their lending and investment activities. And then hedge funds, although hedge fund market is smaller compared to global players, local and regional hedge fund use repos as part of their strategies to finance leverage investment and manage short-term funding needs. And lastly, sovereign wealth funds such as Khazanah Nasional and other government-linked investment companies may also participate in the repo market to manage liquidity and earn safe short-term return on their capital reserve.
Next, we are going to the features of the repurchase agreement. Number 1, short-term borrowing instrument. A repo is a short-term borrowing arrangement, usually ranging from overnight to a few weeks. It serves as a way for financial institutions to raise short-term capital. Number 2, collateralized agreement. The borrower, aka seller, provide a security such as government bonds, corporate bonds, or other high-quality assets as a collateral for the loan. Number 3, two-part transaction. A repo consists of two transactions. The initial sale of securities by the borrower to the lender. The repurchase of the same securities by the borrower at a pre-agreed price on a specific future date. Number 4, predetermined repurchase price. The repurchase price is set at the time of the agreement and include the interest, known as the repo rate. This rate reflects the cost of borrowing. And the last one, low credit risk. Since the transaction is collateralized, the lender has a reduced credit risk. If the borrower default, the lender can sell the collateral to recover the loan.
Next is 4 benefit of investing in repurchase agreement. First is reduce the risk for cash lenders. It reduces the lender's counterparty risk. This is due to the fact that buyers must offer collateral in order to obtain the required finances.
Number 2 is reduce the interest rate. Reduce buyer's repo interest rate. This occurs as a result of the security being exchanged as collateral. Additionally, it is among the less expensive choices available to consumers. Number 3 is repurchase agreement or rewritten agreement. Increased security is ensured by rewritten agreements. To avoid the repurchase, both parties must abide by the rewritten agreement. Number 4 is both party benefits. While the borrowers receive the urgent funds, they required to meet short-term deficiencies. The lenders profit from interest. Okay.
This is for benefit for issuing these instruments. Issuing repurchase agreement offers several key benefits. First, it allows issuer to manage short-term liquidity effectively, raising cash quickly by selling security and agreeing to repurchase them later. The second one is repurchase agreement provide a low-cost borrowing options, as they are collateralized, offering lower interest rate compared to other form of unsecured borrowing. Third one, repurchase agreements serve as an important tool for central bank to control the money supply and regulate interest rate by adjusting liquidity in the financial system. The last one, repurchase agreement give investor a safe, low-risk investment opportunity, since the transaction are backed by collateral, and reducing exposure to potential losses.
So for the conclusion, a repo is essentially a short-term loan. In this transaction, one party sells an asset like government bonds and agrees to buy it back at a higher price. This price difference acts as an interest on the loan. Repos offer several benefits. They help boost market liquidity, provide low-cost funding because the assets serve as collateral, and support overall economic stability. They are also important for institutions like the Federal Reserve, helping with short-term funding needs and ensuring capital markets continue to run smoothly.